Okay, morning. Welcome to the session. Just to inform you that we're recording the session for privacy policy issues. So you have no problem. I'm going to continue. Okay, let's start with today's session. Okay, we're going to be looking at the main elements and components of a set of financial statements. We're going to explain the difference. We've covered that: gross profit, net profit, and cash on hand. And we're going to apply profitability and liquidity ratios to a set of financial statements. Okay, so so just have you from the previous week to have you just make sure that you've completed the activities and that you know what the role of financial manager entails. We covered that last week. Okay, and this week we're going to look at understanding financial statements and ratio analysis. Okay, if we just have a look and recall the purpose of accounting. Accounting is to report financial information so that users of financial information can make informed decisions. Now that is what is financial accounting. Financial management is then where we have to take certain decisions, the investment decision, the financing decision, and the working capital decisions. Okay. This is just a set of financials that you've seen before, just to make you familiar with it. We'll be looking at another set just now. Okay, if we can just look at the recap from last week rather, the gross profit is our sales less our cost of sales. Our net profit is all our income minus all our expenses. Okay, that is then our net profit. Okay, let's look at the financial analysis. If you remember the accounting equation, you've got your assets is equal to liabilities plus owner's equity. So income and expenses forms part of owner's equity, capital, and drawings. Okay, so we have to know what each of these are, and we have to be able to identify them. Okay, so if we look at the terms, the definitions, assets are economic resources owned by the business. Then non-current assets, these are items with a lifespan of more than 1 year. Typical non-current assets, property, plant, and equipment. Financial assets such as investments, and intangible assets such as patents. Okay. Current assets, on the other hand, these are assets with a lifespan of less than 1 year. Okay, so typical current assets would be cash, it would be debtors. Debtors are the people that owes the money to the company, they're the customers. And stocks or inventory. So those are the assets that will turn within 1 year. Then liabilities. These are obligations for the company to pay somewhere in the future. Non-current liabilities. These are liabilities, obligations to pay over a period more than 1 year. Typical long-term loans and bonds over property. Those are typical non-current liabilities. Current liabilities, these are liabilities payable within 1 year. So that's normally like your bank overdraft and your creditors. Then we have owner's equity. Owner's equity is your capital contribution by the owners, less your drawings and your profit. So that is under owner's equity. Net profit is your income less your expenses. What are the types of income that we have? Normally, for a trading business, we have sales. For a service industry business, we've got fees earned. Then we could have things like rent received, if we let out some properties, interest received on investments that we may have. And then expenses, amongst other amounts spent during normal operations, and there is a whole list of those, but things like rent you pay, interest paid, advertising, salaries, etc. Those are your typical expenses. And that is what makes up your income statement and your balance sheet. So your income and your expenses, that goes to your income statement. Your owner's equity, liabilities, and assets go to your balance sheet or statement of financial position. Okay, then they want us to have a look at activity 2C. So I want you to take a couple of minutes and look at activity 2C. It's on page 23. And I want you to classify those in terms of, is it assets, liabilities, owner's equity, or income or expenses? Give you a couple of minutes if you can try and attempt that, please. Okay, I know the activity asks you just to see which of these are operating expenses, but I want you to try and classify this in terms of assets, liabilities, income, expenses, capital, and drawings. Okay, let me talk you through them. We look at the first one, wages and salaries. Obviously, that's an expense. Input VAT. That would be asset, and output VAT liability. Insurance expense, trade payables, the liability. Repairs and maintenance, expense. Sales returns is a negative income. It reduces your income. Water and electricity would be an expense. Interest on fixed deposit, that would be other income. Taxation expense would be a liability. It's not an operating expense. Advertising, it says operating expense. Telephone, operating expense. Trade receivables, that's debtors. Credit losses is a sales. Cost of sales would be an expense, and stationery would be an expense. Okay, so those are the different classifications. They ask just to look at the operating expenses. That's your day-to-day expenses. Okay, any questions on that? Let's just look again at the definitions. Assets, those are resources controlled by a company from past events which will lead to inflow of future benefits. Liabilities, it's an obligation from past events will lead to an outflow of benefits. Income is increase in benefits, expenses decrease in benefits. Capital, that's the owner's contributions. And then drawings, that's where the owner takes up any assets, whether it's money or stock or any other asset for personal use. So those will be the elements. Okay, last week we looked at the gross profit and sales markup. Okay, so in terms of financial ratios, we look at interest. The financial analysis, interest is the cost of borrowing money. It's the cost of debt. Okay, so what we mean by that, if you borrowed 1,000 Rand, which is your principal amount, and you borrowed it at 10% for 1 year, then your interest will be 100 times 10% times 1, so the interest will be 10 Rand. Okay. And then the different forms of financing, we have equity and we have debt. So debt is what we borrow from financial institutions. Equity comes from the shareholders. Okay, there's an activity that you can attempt. I'm not sure what you've covered in Financial Management 1, but if you have compiled an income statement, then you should be able to do that. Let's carry on then. Okay, now we're going to go to ratio analysis. Okay, now what do we mean by ratio analysis? We want to be able to analyze the information, the financial statements, and from there we want to be able to determine whether the business is performing well or whether there are some problem areas in the business. So the first ratio in terms of profitability that we will look at is our gross profit percentage. Okay. Now, what do we mean by that? We will look at our gross profit on our balance on an income statement. Sales less cost of sales gives us our gross profit. We will then divide that by our total sales, multiply by 100, and that will give us a percentage. Okay. Now, with ratio analysis, simply to say that my ratio this year is 30%, it's not very helpful because we need to compare 30% to something. Okay, so we normally will compare it to the company's previous year's figure, or we will compare it to an industry average. Okay, what do you mean by industry average? On the stock exchange, the different companies are listed in different sectors, for example, property companies. So these financial statements are available for all the property companies listed on the stock exchange. One will do these ratios that we are looking at today for all the companies and work out an average. And we call that the industry average. So if we compare our 30%, we want to compare it to the industry average. If the industry average is 40%, then we know we're well below the industry average and that we have some problem we need to fix. Okay, so this is what we do with these ratios. If we look at our percentage of 30% and compare it to a prior year, let's say it was 25%, which means that we have improved my gross profit percentage. So then we can say, yes, the company is moving in the right direction. So that is the first one, is the gross profit percentage. Then we're going to be looking, the next one is our net profit percentage. Okay. Now what we do there is it's a similar formula. We take the net profit, that's your profit after interest and tax, and we divide it by our total sales times 100, and that will give us our net profit percentage. Then we have a third one, return on average owner's equity. Okay, when we talk about average, it simply means we will take the previous year's figure, add it to the current year, and divide it by 2. Okay, so that is what we mean by average. In this case, owner's equity. So you will look at last year's figure, you will look at this year's figure, add them together, divided by 2, and that will give us our percentage then. Then we can look at liquidity ratios. We have different types of ratios there. First one is called the current ratio. And that is the current assets divided by current liabilities. Now, what is the current asset? What does this ratio mean? It means that if I have to liquidate my current assets is your stock, your debtors, your cash. So if I have to liquidate that, will I have enough money to pay my current liabilities? Current liabilities will be your creditors, bank overdraft, whatever current liabilities you may have. Obviously, this ratio then indicates whether you are liquid, if this ratio is above 1. If it's below 1, it means you don't have enough cash to cover your liabilities, and then you're in serious trouble. Not you, the company. So you're going to take your current assets minus your current liabilities. The second one is called the asset test. Okay. The asset test is also called the quick ratio. And what does that mean? If we take our current assets and we subtract our inventory from that, we take that amount and divide it by the current liabilities. We want to see if I cannot trade anymore. In other words, my inventory is gone for some other reason. Will I have enough cash to cover my current liabilities? And this is where a lot of companies fall short. where they, they don't have enough other current assets to cover the current liabilities. Now, if you think about the floods that happened in KZN last year, where, and even the riots the year before, someone comes into your shop, or the water comes in, either steals all your stock, or all your stock gets damaged by water. If you do not have insurance, you won't be able to pay your current liabilities if this ratio is below 1. So you want this ratio to be at least 1. If it's below that, then you have serious trouble. Okay. Then we have our average trade receivables collection period. So average trade receivables, we take our trade receivables this year plus the one of last year divided by 2 and multiply by 365. And we're going to divide that by the credit sales. Okay. We only use credit sales. We can't use all the sales because not everything was on credit. If everything's on credit, you will use sales, but it's normally not everything's on credit. And you will be given this information if you ever have to do this ratio. They will tell you how much of your sales is on credit and how much is cash. Okay. Then you have your average trade payables settlement period. So I want to come back to the collection period. When you sell on credit, you give your customers normally 30 days or sometimes 60 days to pay their accounts. Now, this ratio tells you how long it takes you to collect your money from your debtors or trade receivables. Now, this would normally be somewhere in 30 to 40 days should be, ideally is where it should be. If it tends to go longer, if you find some, if it goes to 60 days or 90 days, then you are in trouble. It normally indicates that some debtors will not be able to pay you and you're going to have to write off bad debt. So in real life, financial managers, this is one of the things they monitor every month to make sure that the debtors' days stays within a particular range that they are happy with. Okay, so that's the trade receivables collection period. Then we have the average trade payables settlement period. This is again how long it takes you to pay your creditors. Okay, so it's going to sorry, it's again the average trade payables. So you take this year's figure plus last year's figure divided by 2, you multiply by 365, and you divide it by credit purchases. And that'll give you your time it takes you to pay your creditors. Again, when you buy on credit, your suppliers will give you 30 days or 60 days to pay, and you must make sure that you stay within those days. And this ratio will give you that. Then we have what is called our average inventory turnover. What we mean by that is how often do you replace your stock that's on your shelf? That's in simple terms. So if you think about Pick n Pay, there's a tin of baked beans on the shelf. This turnover tells you how often do they put a new tin on the shelf. Okay, but obviously this is now for the total of stock, and that is what it is, the cost. So what you do is you use your cost of sales and you divide it by your average inventory. Again, average inventory is what your inventory last year's figure plus this year's figure divided by 2. Okay, any questions on these? We're going to work through an example so that you can see what we mean and how we calculate these. Okay, we're going to work through the example. Let's just get the right one now. Example 2E, that's on page 32 in your textbook. Okay. So I've just typed the figures here so that you can see. But I want you can follow it in your textbook or you can follow it here, but I want to just show you where all the figures come from. So there's your income statement. You've got your sales, less your cost of sales, 390 less 280. That gives you a gross profit of 110. Add other income, 3 less expenses of 81. That gives you a net profit of 32. And so that is your income statement. Then you go to your balance sheet. Oh, sorry, this didn't come out properly. But you have the textbook in front of you. There's your balance sheet. I put 2004 and 2003, the prior, just some figures. I'm not going to retype everything. So there's your assets, your non-current assets, current assets, total assets, the owner's equity, non-current liabilities, and current liabilities. So those are your balance sheets. So let's look at the different ratios, the gross profit percentage. So the ratio for gross profit percentage is gross profit divided by sales times 100. So to go back to the income statement, there's your gross profit 110 divided by 390, your sales times 100. And that'll give you 28.21%. So this is not a difficult ratio to calculate. Then you get your net profit percentage. Okay, so again, it's your net profit. Net profit, there we go, 32 divided by your sales of 390 times 100. And that will give you 8.21%. Okay, so that's your net profit percentage. Okay, then we look at return on average owner's equity. Okay, so I did put there's the owner's equity, 273. And the previous year was 209. So you'll add them together, divide by 2. And there's our profit divided by our owner's equity. The 32 is your net profit divided by 273 plus 209 divided by 2. That gives you your average times 100. And that's 13.28%. Okay. Then we look at our current ratio, which is our current assets over current liabilities. You'll go to your balance sheet. There's our current assets, 107, the total. Current liabilities is 42. And 107 divided by 42 gives you 2.5521. Okay, this is a ratio, so it's not a percentage. It's 2.55 to 1. So what it means, for every 1 rand of current liabilities, I have 2.55 rand of current assets. Okay, if we then go to our asset test or quick ratio, which is my current assets minus my inventory. So let's go to my balance sheet. There's my current assets, 107. There's my inventory, 58. So 107 minus 58. Divided by 42, the current liabilities, 1.1721. So yes, in terms of the asset test, this company will still be able to cover its liabilities if it should stop trading. Okay, now, normally when they give you an income statement balance sheet, they will give you some notes. So if you go to page 33 in the textbook, I just put some of the notes. Yeah, they didn't come into my When I copied it, it didn't show. They give you certain information. So if you look at this example, they say the business marks all product up by 50% on cost. Okay. 80% of all sales are on credit. That's a very important one. 80% of all sales on credit. Okay, so if we go to this ratio, average trade receivables collection period. Okay. So the formula that we use for that is our average trade receivables divided by credit sales. So we will go to trade receivables, the average is 49 plus 31. Okay. And then we have to go to our sales of 390, but they say 80% is on credit. So we're going to take 80% of our 390. So then you'll see the 49 plus 31 divided by 2 times 365 divided by the 390 times the 80%. Okay, and that will give us 46.79 days. Okay, if we then go to the next one, our average trade payables. Okay, so we go to our balance sheet. Trade payables. Okay, it's cut off there. So the trade payables, you will see it is 22 and 21 the previous year. 22 plus 21 divided by 2 times 365. Okay. And the formula, we're going to divide that by credit purchases. Okay. So now you have to look at the notes again. On the top of page 33, where they say 75% of purchases are on credit, and purchases equal 60% of your cost of sales. So what you have to do, you have to go to your cost of sales on your income statement. There's my cost of sales, 280. So I'm first going to take 60% of that. Okay, because that is purchases. And then of that 60%, I'm going to take 75%, which is on credit. Okay, so if you then look at the ratio, it's the calculation, it's the 22 plus 21, so trade payables divided by 2 times 365. Then we're going to divide that by the 280 times the 60% that's on credit. Sorry, 60% that is purchases times the 75% which is on credit. And that gives us 62.28 days. Okay. Then we have our average inventory turnover. And the formula for that is our cost of sales divided by average inventory. Okay, so if you go to your cost of sales, you'll find in your income statement 280, and your average inventory in your balance sheet. There's our average inventory, 58 plus 33 divided by 2. And that will give you 6.15 times. That means that you replace your stock 6.15 times. Okay, just as a matter of interest, you can also calculate the number of days it takes you to turn your stock. 6.1, if you take 365 days, you divide it by 6.15, that will give you how often you turn your stock. Now again, this average inventory turnover is an important ratio. You want to turn it fairly quickly, but it all depends on the type of industry you are in. If the principle, if this inventory turnover slows down, if you now go down to 5 times and 4 times, it means you're turning your stock slower. That could have a couple of reasons. It could be that you're buying the wrong stock. It could be that you've got some obsolete stock, or it could be that you're buying too much stock. So it's a very important ratio that you must look at. So you must compare it to the previous year and the year before to see if it improved or not. So if you look at the example in the book on page 35, it was 16.72 times. It came down to 12 times and now 6 times. So that's a serious problem, as it is now turning it slower and slower. Okay. Okay, any questions on these ratios? I'm going to work through an example, an exercise. Okay, when you look at financial analysis, when companies make a profit, they have to decide whether they're going to distribute the profit to shareholders in dividends, or they're going to keep a certain portion in the company as retained earnings, which you will need for future growth. Okay. So okay, I want you to go to activity 2G. That's on page 36. And I want you to work through that activity. Okay, so if we can just go through that. Okay, if you go to on page 36, where they give you the trading account, the trading account, you'll see on the credit side, you've got sales, 744, and then on the left, your cost of sales is 405,120, which means you've made a gross profit of 338,880. Okay, I've just given it in a different format, but that is your gross profit. And then if you look at the profit and loss account, at the bottom, you will see there is the capital net profit of 8542. So that's your net profit. Okay, so they want you to calculate the gross profit percentage, net profit percentage, return on average owner's equity, your current ratio, asset test, trade receivables, trade payables and trading inventory turnover. Okay, I want you to work through this. I'm sitting online, so if you have any questions, please ask me and I can assist you. Okay, let's yeah, to get you going. So if we look at the first one, your gross profit percentage. Okay, the formula is your gross profit divided by your sales. So if you go to your profit and loss account, you will see here there's your profit of 338,880. You're going to divide that by 744,000 in sales times 100. And that will give you 45.55%. Just try that, see if you get that answer. Okay, okay, then I want you to do the next one, your net profit percentage. What is your net profit percentage? Your net profit. So you'll go to the bottom of the profit and loss account. You'll find there's your net profit of 8542. Then you're going to divide that by your sales of 744 times 100. Then that should give you 10.83%. Okay, so the next one is your return on average owner's equity. Okay. So the total of owner's equity for the current year is 653,137. If you look at your balance sheet in the last column, you'll see 653,137. And the column before that, you see there's capital 582,514 plus profit 8,542 less drawings. So that capital of 582,514 is the figure from the previous year. So if you want to calculate the average, you're going to take the 582,514 plus the 653,137, add them together and divide by 2. That'll give you your average. Okay, and that should give you 13.04. If we look then at the next ratio, your current ratio, which is your current assets over your current liabilities. Okay. You'll go to your balance sheet, you've got your current assets, 47,035, divided by your current liabilities of 16,552, and that will give you 2.84 to 1. I'm going too fast. You must, if you have questions, please ask me. The asset test. Hello.
Sir, please
Yes.
go back to the return on average owner's equity because I didn't hear that part.
Okay. The return on average owner's equity. Okay. If you look at, because you have to get the average, which is this year's equity plus last year's equity divided by 2. Now, in the layout that they've given us, if you look at the balance sheet, it's got 3 columns. So if you look at the column on the right, that's your current year's values. Okay. So and total. So you'll see the total for this year is 653,137.76. So that's the current year's value. In the one left to it is your changes in your equity. In other words, it starts with your capital. So that's last year's capital amount, plus your profit, less your drawings. So that 582,514.80 is the value of the previous year. So you're going to add the 582,514.80 plus 653,137.76 and divide it by 2 to get your average. Is that clear?
Yes, thank you.
No problem. Okay. Okay, so where are we now? Okay, the asset test, you'll go with your current assets minus your inventory. So it's 47,035.96 minus 25,890. And then the answer to that you divide by your current liabilities of 16,552.20. And that gives you 1.28.
Two five eight 90. Sir, for inventory, did you use the 25890?
Inventory, let me just check. The inventory 25,890 is my inventory. Yes. Okay, so let's go to the next one. Is our trade receivables collection period. Okay, so we have to find the trade receivables collection period is going to be average trade receivables divided by credit sales times 365. Okay, so we know what the current trade receivables are. We go to our current assets, and it's 21,145. Okay, and then under the notes, bullet point 1, 2, 3, 4, 1, 2, 3, 4, 5. Yes, they said the net trade receivables the previous year was 22,424.82. So we're going to add the 22,424.82 to our current one, trading assets, so the receivables 21,145.96. Okay. And now we have to find out how much credit sales we had. Okay, so we go to our notes. In the second bullet point on the notes, they say, assume 365-day year, 55% of all sales are on credit. And then they say, so 55% of sales, so you'll go to your sales of 744,000, and you're going to take 55% of that. Okay, does that make sense? So your calculation will be your trade receivables is 21,145.96 plus 22,424.82. Divide that by 2. Multiply by 365 days. And you're going to divide that by 55% of 744,000. Okay. And that will give us a figure of 19.43 days. Okay, then we can look at trade payables settlement period. The formula for that is your average trade payables divided by credit purchases. Okay. Our current trade payables and our current liabilities is 12,261. And then bullet point on the notes 1, 2, 3, 4, 5, 6. They say the net payables was 18,222.48. So I'm going to add 18,222.48 to 12,261.80 and divide it by 2 to get our average trade payables. And we're going to divide that by our credit purchases. And in the second bullet point, on the notes, they say credit purchase for the year amounted to 171,500. Okay, so we're going to take the calculation will be 12,261.80 plus 18,222.48 divided by 2, multiplied by 365, and we're going to divide that by 171,500. Good. And that gives us 32.44 days. Okay, and then we can go to our next one, trading inventory turnover. So the formula for that is your cost of sales divided by your average inventory. So if we go to our current assets, our inventory is 25,890. Current year, and the last bullet point on the notes, they said the previous year was 42,300. So you're going to add 42,300 plus 25,890 divided by 2. That gives you average inventory. And you're going to divide that into your cost of sales of 405,120 from your income statement. And that will give you 11.88 times. Okay. Any questions? Okay, so next week we will be talking about depreciation and disposal of assets. Okay, I hope you can follow this ratio analysis. Yes.
What was your answer for the average trade inventory?
The average trade inventory. Let's check. The average trade, it's the cost of sales is 45120 divided by 25,890 plus 42,300 divided by 2, and that gives us 11.88 times.
Okay, thanks, sir.
Okay, no problem. So if you want to, you can perhaps practice at home activity 2H, 2I as well. And then if you have any problems, we can discuss it in class next week. Because it's much easier if we're in class than to explain there. But okay, thank you for attending. And then any questions further? Okay,
No, sir. Thank you.
Thank you very much. We'll see you then next week in class. Have a good evening, afternoon rather. Okay, goodbye.